So recently, the media has been really talking about how the S&P 500 and the Nasdaq, they're both in correction territory. So they're saying the S&P from its high in February is down about 10%, and the Nasdaq 100, the QQQ, is down about 11.3% as of this video from its high in February. But what they don't tell you is that from the beginning of the year, the S&P is only down about 4.3%, and the Nasdaq's only down about 6.45%. Yeah, I mean, they're down, but they're not down in correction territory. And in the past year, so from March 14th of last year to March 14th of this year, the S&P 500 is still up over 9%, and the QQQ, or the Nasdaq 100, is up close to 9%, about 8.9%.
And it's important to note that the stock market has been on a crazy run lately. In the past 5 years, the S&P 500 is up about 107%, while the Nasdaq is up almost 150%. So while things may seem bad in the short term, if you extrapolate things out to 5 years, the market is still up a lot.
So we want to do a special edition of our podcast simply because the media this year so far has been doing a really great job at creating a bleak picture of our economy. You know, my name's Steve Borstein, and I'm with Aiden Borstein. We're both financial planners here at Rockcrest Financial, which is a financial planning and investment management firm in Summers Point, New Jersey. So, you know, the news, again, is trying to really stoke the volatility fires. And of course, the news outlets love greed and fear, right? I mean, they're not here to kind of make you feel good about everything. They're here to try to get your eyeballs to keep watching their news stories and websites and, you know, TV in order to try to sell advertising. So what they're giving you is kind of the incomplete picture that kind of gets you to watch, not the reality like the numbers we just talked about,
yeah,
right?
Exactly, yeah.
Now look, I mean, with that said, we both realize how unsettling any kind of downturn is. Any type of correction, you know, even if the market's not down year to date in that correction territory, it's still your hard-earned money, right? I mean, it's still your finances, your goals, you know, your financial plan. And so we realize that it doesn't feel good, and that's part of the emotional part of kind of investing in the market. But at the same time, as history has shown us, we've had 8 major corrections. So when I first started in the industry, it was 1999, and in 2000 to 2002, we had the dot-com bubble. And that's where the S&P dropped 49%, and the Nasdaq dropped 78%. Could you imagine a 78% drop today? I mean, if you had $100,000, you had $22,000 at the end of that period if you were 100% Nasdaq. I mean, that was a very scary time, but the market recovered. And then again, in 2008, 2009, we had the mortgage market crisis, and that was huge for the markets. I mean, the S&P then declined 57%. So again, that was a huge amount for that time period, right?
And since then, there's been a crash in 2010, 2011, 2015 to 2016, there was a global growth concern which caused the S&P to drop again. 2018, another drop. And then 2020, shortly after I started in the industry, was the COVID-19 pandemic, which caused a sharp decrease, which was a 34% drop in the S&P 500. Shortly after that, in 2022, another drop happened because of inflation fears. Another drop in the S&P, around 25%. So as we continue seeing these drops in the market, it's easy to look at what's going on now and seeing how there's different policies that might be affecting the market.
We now have, and this is not a political conversation today, but we now have a president who's making a lot of changes with tariffs and crypto and different things that we haven't been really exposed to for a long time in economic policy. And so everybody said, well, it's different this time. The market's never going to recover. And in 2000 to 2002 with the dot-com bubble, and this is like the change of things where we had companies like search engines like Yahoo and Google, which were never around before. And when it burst, and even the Nasdaq went down 78%, people said, well, it's different this time. It's never going to recover. And it did take a while to recover, but we did recover way more than what those highs were before they dropped.
And a great way to look at this is to take a look at different time frames on the charts. So if you take a look at the S&P 500 and you look at a 3-month chart, it looks pretty scary.
Yeah.
It looks like the market has tanked. But if you extend that out to 1 year, it still looks pretty bad, but it doesn't look as bad. Going out to 3 years looks a little bit better. It looks like a small little market correction. And then if you bring it out to 10 years, it barely looks like it made a dent in the market because the market has risen so much since that 10-year mark. So time horizon in the market is a very big consideration when it comes to staying invested in the market or selling some of your positions in major stock market positions.
As we kind of mentioned at the beginning, the market's down 11% from its high in February, the Nasdaq, but it's down only 6.45% since the beginning of the year. It's actually up 8.93% since it was this time last year. And what was your number on the 5-year?
For the past 5 years, the Nasdaq, for example, was up almost 150%. So bringing the time frame out gives you a better idea of how these market corrections look on a larger time frame.
Yep. So what we wanted to do today was we wanted to share with you our 5 top tips on helping to survive any type of market correction and really actively reduce your investment risk.
So the first tip that we wanted to talk about was risk. Now, for our clients, we usually go and take them through a risk number questionnaire to get a more accurate number of what their risk could be so that we can help them invest at that risk level. A good strategy for this would be to take a look at your time frame, when you plan on retiring, your age, and a bunch of different factors that can help you better identify the amount of risk you'd like to take in the market.
Yeah, I mean, there's questionnaires all over the place. Vanguard, Fidelity, Schwab, they all have risk questionnaires. If you have a 401k, a lot of times the 401k site will have some type of risk questionnaire. The important thing is not just thinking that, well, I'm young, I can take on a lot of risk, or I'm older, I need to be more conservative. You really should develop what we call a risk number that's based off of you. It's based off of not only your personal situation, but your financial plan.
Something that also helps you sleep at night. If you can't stomach, even if you're very young like myself, if you can't stomach seeing a large drop in your portfolio, maybe you take a more conservative approach.
Yeah. So really, your risk tolerance or your risk number is really entirely up to you. And no advisor or your friends or whatever should tell you, kind of what risk level you should have.
The second tip is asset allocation. So everybody talks about diversification to help reduce risk, which is true, but asset allocation may be even more important when it comes to reducing risk.
So being asset allocated would be making sure that you have large United States stocks, small United States stocks, international bonds, domestic bonds. It's really making sure that you have many different kinds of assets. So although diversification is important, making sure that you're not concentrated in any one kind of investment is really the most important.
And then once you're asset allocated, the third tip that we'll talk about is rebalancing. This is another thing that we do for our clients directly. Some of the financial investing software out there allows you to automatically rebalance portfolios, but rebalancing helps you keep the same asset allocation.
So let's say you have a portfolio that's 50% stocks and 50% bonds. Over the past 5 years, the S&P 500 has gone up what?
About 100%.
About 100%, right? So let's say you have $100,000, $50,000 of your stock portfolio grows to $100,000. And let's say bonds really haven't grown over the past 5 years. So $50,000 of your bonds is still $50,000. Now you have a $150,000 portfolio. $100,000 of it is stock, right? So now that means 66 or 67% of your portfolio is now stock when you really only wanted 50% of your portfolio as stocks. And the problem with that is if the market drops 10, 20, 30%, it's now 67% of your portfolio that drops 10%, not 50% of your portfolio that drops.
The fourth tip is making sure that you have a solid financial plan that covers all 5 areas of personal finance. And to us, that means the financial plan itself, investments, estate plans, tax strategy, and insurance and risk mitigation.
So it's important to make sure that when you create your financial plan, that it embodies not only all your goals, but your values too. And by doing so, you can focus on what's important, which isn't the short-term moves of the market. It's not the market noise. It's that the plan should lead your investment strategy, not your investment strategy leading your planning.
And that leads to our last tip of just tuning out the noise. If you recall, over the past few years, as the stock market has risen dramatically, everyone on the news was causing for a market crash, a market downturn, or some sort of recession from the COVID recovery. Now that the market is finally dropping, fear is everywhere you look. So if you look on social media, if you watch the news, everyone is talking about how the market is dropping and people are actually scared. So if you just rely on a solid financial strategy and rely on some solid financial professionals in your life, you have a better chance of reducing this overall financial stress.
Yep. So in the end, your financial plan should guide your decisions, not short-term temporary moves in the market. If you have any questions or you don't have a financial plan and you're looking to create one, please feel free to reach out to us and be more than happy to talk with you. We're here to support you and answer any questions and ensure that your financial future remains on track.